Welcome back, guys. It's been a few weeks and today I've decided to share some of my views on the current market. It probably isn't news to you that the S&P 500 is now officially in a bear market. That's more than 20% drawdown from its all-time high. This is because investors are preparing for an oncoming global recession where the companies and the countries of the world are not going to make as much money as they normally would. But as usual, I have my own opinions about what's going on, and sometimes they're not the same as everybody else. This is just my opinion. I'm just another idiot on the internet. I'm ridiculously new to investing, and I'm not doing particularly well. But I'm here to talk to you a little bit more about the goal of the impending interest rate rises and what I'm doing to prepare myself for when there isn't a recession. This is different to me just telling you about how inflation is the highest since the 80s and it's all the central bank's fault for printing all that money. Wait, no, it's Russia's fault for printing all the money. I also have my own opinion on the stock market in general and why I don't think it's got much further to fall. And I'd love to hear your opinions on maybe why I'm wrong. And finally, I have a portfolio update and I'll be showing you exactly what I plan to be doing with my portfolio, and I'm going to take action on it right in this video. But first, the news has been obsessed with sky-high inflation, the highest inflation since the 80s, and a looming recession. One of my investing heroes, Stanley Druckenmiller, a man who achieved 30% returns year on year throughout his investing career. He is severely pessimistic on the current global economy. And in a recent hour-long interview with the co-founder of Stripe, he lets you know it. I like Druckers because he always clarifies that what he's thinking is just his opinion. He knows he doesn't really know what's going to happen in the stock market, even though he's pretty much the most successful person in the world at it. And that's probably one of the main drivers of Stanley Druckenmiller's success. He's open to being wrong. The interview is still very, very bearish, but what did catch my eye was something that was slightly glossed over a little bit.
Once inflation gets about 5%, it's never come down without a recession, and I think a recession is in the cards. I just don't know when. We have about, depending on who you listen to, $1.5 trillion to $2 trillion of excess savings now. So it may take some time to work through that savings, but given the extent of the asset bubble and the destruction in the markets, given what's going on in Ukraine, given zero COVID policy in China, I don't take a lot of comfort from that. So I assume, and I pretty strongly assume, we're going to have a recession sometime in 23. I just don't know whether it's going to be in the early part or the later part. And again, it's a guess. It's not a fact.
It's interesting that he pointed out savings. Not a lot of people have done that yet. We can sit here all day and talk about interest rates and China lockdowns and supply chain issues, but I think that here in personal savings, this is where the recession is determined. In 2020 and 2021, the US Federal Reserve dumped a load of cash on the public and local businesses, and here in the UK we had the furlough scheme. This is where hundreds of thousands of people stopped working, stopped doing anything, and earned 80% of their original pay paid by the government. And they couldn't spend any of that money because there was nothing open. If I sound bitter about that bit, it's because I can. Working in the NHS at the time, all we did was work double the amount and get paid less. Still stings a bit. Bitterness aside, this led to the US and UK personal savings rate to rocket to all-time highs. This led to a lot of cash sitting in ISAs and premium bonds, all waiting to be spent on something. Some of it may have even made it into crypto, but it's probably not there anymore. More money in that system leads to more people willing to pay more for more things, hence inflation. Not just any old 2% inflation, no, the UK is currently at 9.1%, that's the highest inflation of all G7 countries, higher than the United States of America. By the way, thank you to friend of the show Genuine Impact who provided all of this information on their email subscription service. But these massive amounts of savings that are still sat in just regular bank accounts got me questioning what's really going on. After all, this helicopter money was given out indiscriminately and now the governments are going to want it back. That's why food, fuel and energy prices seem to have the most ridiculous inflation of all, with food counting for 50% of all inflation in the UK. There's even reports out of supermarket that people are stopping themselves from going over £30 limits because they just can't afford it. But what's really surprising is there's been no significant tax relief. Why is that?
Jerome Powell has testified in front of the Senate for the past 2 days about monetary policy and what the Fed has been doing over the past year. He stated that the Federal Reserve does indeed have a balancing act and it will be difficult to avoid a soft landing, aka a recession, but they do need to get inflation under control. He stated that the economy is strong and that the Fed was not trying to provoke a recession, but the thing is, the Fed can't save the economy on their own. They just can't. They need help from the people that Jerome Powell was testifying in front of, but it was clear from the questions that the Senate was asking him that they feel no responsibility towards what has happened. Research from the San Francisco Fed shows that both supply and demand have driven inflation, and the Fed can only really nudge around demand. Supply comes from fiscal policy, like giving more support to oil companies, because energy is a primary driver of inflation. We can blame the Fed all we want, but action has to happen, especially at the policy level.
Because the governments want that money back, they need to even out those balance sheets before they get absolutely out of control. Some would argue that they're already pretty out of control. You want to go on holiday? They will probably make you pay for jet fuel and drinks. You want to stop Nana dying over the winter? Well, you better cough up the cash because you don't want the grandkids walking in on a grandma popsicle. Interest rates could go up quicker, you know. They could boost it by 1%, maybe even 2%, and really bring that inflation down quickly. But there's nothing like the warm and constant gradual squeeze of a cozy hug. You feel it a little bit less. It comes on a little less sudden. Like tightening up the belt a little bit harder on your next ex-fixie wank. Google it. The truth is the UK bank accounts are still jam-packed full of this helicopter money. And there won't be a recession until all that money is bled dry by inflation. Until there's no more money for the governments to take back. They're hoping that things are going to get so expensive that you start to have to dip into those savings to pay for it. And as a system, it's going to get a lot harder. But can we beat this? Can we do something other than spend our savings and therefore come out of this recession better off? If it's my savings that these companies and governments are after, the best thing I can do is be mindful of this. Others that I know right now are already spending that money on cars and holidays because they didn't get to do it in 2020. That's pretty stupid in my opinion, considering the economic squeeze that we potentially have coming. My plan for the next 2 or 3 years at least is to live like shit. Now I know this isn't going to be popular, but over the next 2 or 3 years, I think my best bet is to really rein in my spending and be mindful to spend less in the areas where inflation is so high. Food is obviously a bit of a tough one, that's a hard one to get around, but even me who's been quite frugal over the past couple of years has started to see myself eating out a lot more. I need to really rein that back in because that was probably the main secret to me filling my ISA every single year. I think I'll be going on less holidays to places where I actually have to spend money to get there. However, if there's places where I might have family or places abroad where I could go to work and do a working holiday, I am not against that at all. And here is some actual financial advice. Not stuff that I'm just doing, but stuff I think you should be doing as well. If you're doing all these things and saving all this money, keep it to yourself. Don't make a big deal about it to your friends and family. If your friends are splashing out on expensive shit, don't try to convince them not to. It probably won't go down well, and all they will try to do is try and justify their own spending by saying things like, "Oh, why have all this money if you're not going to spend it?" It's always the broke dude who's saying that, or it's always the fat one who's trying to make you eat more. I need these people to keep spending their savings on frivolous crap. I need them to pay off my share of the national debt. I'm probably going to get a job that's closer to home that pays me a little less money. I'm currently earning $250 a day and spending 150 quid on it just to get there. I know this sort of thing probably isn't going to settle very well with people, but like I said, you don't have to do it. Please keep spending your money. I'm desperately going to plan to hold on to and increase my savings over the next couple of years. The market though, I'm not entirely sure the story is the same. The S&P 500 officially hit the bear market last week, going down 20% from all-time highs. I don't think we've hit the bottom here, and like Druckenmiller, I do think there's more pain to come. but I don't think it's going to be the 50 to 70% amount of pain that, say, Ray Dalio thinks. This is a graph of the SPY. This is the Spider S&P 500 Trust. It's basically the ETF you would probably buy if you were investing in the S&P 500 in the US. It's nothing more than just another stock, but instead of the earnings being correlated to just one business, all these earnings on the orange line right here are a makeup of over 500 businesses in the US. And with this historical information, we can make a couple of assumptions. By the way, the price here of the SPY includes fees. It doesn't include inflation, but it does include the fees you would pay if you were invested in the SPY ETF. So when we're talking about this black line, the S&P 500 price, this includes fees. This orange line is the historical earnings growth of the entire S&P 500. This is the price of what you would expect the SPY to be if it was trading at a 15 times earnings. 15 times earnings is a good place to start. It's kind of the historical average. Some would say it's 17, but it's not set in stone. You can kind of work around this reference point. This solid orange line is earnings that have already gone past, and the new dotted line afterwards over the next 3 years is earnings estimations. And these are not new earnings estimations. These will change consistently as earnings analysts update. So it's possible out here in 2024 that these earnings estimates haven't accounted for the new inflation figures yet. But they won't be that far off because these numbers are updated daily and they do take into account some of the new interest rate rises. So we can expect it to be a little bit less, but not too much. And if you believe these numbers and you believe we're in a recession right now and we would start to recover, say, in 2023, then the S&P 500 doesn't actually have that much to fall. It only has about 7% more to drop if it's going to contract to a 15 PE multiple. However, if investors still continue with this fear, then in the short term, it could be really damaging. It really could drop down by another 20%. That's still not as bad as the 50%, but it's still quite a bit of a way to go. And why do I choose this orange line, this 15 PE ratio? Because historically, that's where the market comes down to. During the most recent drawdowns of the S&P 500, the S&P 500 price has really only come down to 15 times earnings. That's on 1, 2, 3, 4, 5 occasions, including the COVID crash. Obviously, this time can be different and it can overcorrect to the downside. We can only hope for that, to be honest. But if recent history is anything to go by, over the next 3 years, we could see the SPY come down to 348. And what got me really interested in the predictability of this market is that in 2017, CNBC reported that Jack Bogle, the inventor of broad-based index funds, in 2017, they were saying that Jack Bogle believes the stock market would only return 4% annually over the next decade. That is in complete contrast with the FIRE people that say that 10% is the average return of the S&P 500. Because it is. And if I take the starting price of 2018 and link it up with the earnings growth in 2024, there you go. You get that 4.5%, that 4% expected to return over the next decade. This price is already starting to fluctuate. It's already starting to revert to that mean. And maybe Jack Bogle was right. He might be off by 1% or 2, but he's definitely calling it that it's going to be less than 10%. My portfolio currently sits at 46,895 and I've dropped in £1,000 today during this bear market to show you that I am not changing anything and I'm continuing to dollar cost average into my market. And I'm really sorry to have you on a bit, but it's 12 o'clock at night right now and I think I'm going to save this for another video. But I'm planning on putting £1,000 into the S&P 500 tomorrow and I will show you that in the next video. Thank you very much for watching, guys, and if you enjoyed this video, please feel free to like, subscribe and argue with me in the comments.